One major issue is holding back the financial future of most young people. Housing. The rising cost of housing has placed homeownership beyond reach for many. For those who do not already own a home, affording one has become nearly impossible. Even renting has become a significant financial burden. Some hope for a housing market crash to level the financial playing field, but such a crash would likely worsen the situation. Housing prices continue to rise across the United States, partially driven by higher interest rates. Buyers and sellers alike are struggling to close deals. Data from Adam reveals that homes are now unaffordable for the median earner in 99% of U.S. counties. The remaining 1% had insufficient data to be analyzed, not better affordability. Many Americans are left hoping for a market correction to bring prices down. Yet high prices disadvantage everyone: buyers, renters, and even current homeowners. For renters, affording a place to live increasingly requires roommates. For homeowners, selling at a record price often means buying again at another record high, providing no financial gain. Higher property taxes and capital gains taxes on homes that have appreciated beyond the IRS's Section 121 exemption of $250,000 further complicate matters. Unless someone owns multiple properties, the financial benefits are minimal. Often, the only real winner is the government through tax revenue. If housing prices are too high, it may seem logical to hope for a crash. However, a market crash would likely make it even more difficult to buy a home for several reasons. First, those unable to purchase a home today would not be in a better position during or after a crash. While it is possible to buy a home with as little as 3% down, many buyers face barriers beyond just the down payment. A 97% drop in home prices, which would allow cash purchases, is extremely unlikely. During the 2008 crash, prices dropped only around 20%. A survey by NerdWallet and Harris Poll found that 37% of non-homeowners cited the lack of a down payment as their main barrier, while 42% cited other challenges such as lender requirements. Lenders look for a sufficient down payment, good credit, and the ability to make consistent payments. Their underwriting rules, often proprietary and risk-averse, vary widely and can change at any time. Even with a mortgage payment lower than current rent, applicants may be denied due to how income is categorized or how other financial obligations are weighed. After a housing crash, lending becomes even more restrictive, further reducing access to mortgages. The 2008 crash demonstrated this reality. Despite falling prices, a surge in listings, and historically low interest rates, the number of home sales dropped sharply. Potential buyers were ready but couldn't secure financing. That marked just the beginning of the problem. Talk of a real estate crash is a popular topic online, with many hoping such an event would offer a rare chance to buy a home. While this idea gains traction, the reality is more complicated. For prices to fall significantly, either buyers must lose purchasing power due to job losses, or banks must reduce lending. However, unemployment is currently near historic lows, and if lending stops, those hoping to buy with a mortgage will be left without options. Should job losses occur, young potential buyers are likely to be among the first affected. After the 2008 crash, investment firms like Morgan Stanley recognized that average Americans could no longer afford homes. Their 2011 report predicted a shift toward long-term renting. Institutional investors took advantage by buying homes and converting them to rentals, profiting from rising rents while others were locked out of the market. Another challenge is that many current homeowners are not selling. Locked into historically low mortgage rates, they have little incentive to move and face higher monthly payments. Some opt to rent their homes instead of selling, maintaining low-rate mortgages while collecting high rents. A flood of sales is unlikely, especially since today's lending standards are tighter than before 2008, reducing the risk of widespread foreclosures. Building new homes could help, but construction is lagging. The U.S. is building fewer homes now than it did decades ago, despite a much larger population. Zoning laws, NIMBYism, and restrictive building codes slow down and increase the cost of construction. Nearly half the cost of a new home comes from local rules and regulations rather than materials or labor. Additionally, the cost of land has risen so much that developers struggle to make new projects financially viable. Most profits are now tied up in the land, not the construction itself. Builders face narrow margins and use expensive development loans, making new construction risky, especially in a declining market. Renovating existing homes is often safer and more profitable. If land values fall during a crash, developers are even less likely to build, further constraining supply. Throughout history, real estate has transitioned from a privilege of the elite to an attainable goal for average families. However, rising prices are pushing it back out of reach. Millions, especially young people, find themselves unable to afford a home, and waiting for a crash to solve this will likely lead to disappointment. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.